Andrew Malcolm here, Mortgage HQ, and today we're doing cash flow for investment properties. It's cash flow for dummies. So we're going to look at gross yield on an investment property. So we're going to take a $1 million purchase price. And the key thing with investment properties is most of the time we're looking at the high level numbers using interest only repayments. We're not doing principal and interest, it's interest only. So in this instance, we're going to use 2.5% as the interest rate. We're going to do the purchase price at 100% finance. We're going to times that by the rate, and we're going to get a $25,000 a year cost to borrow that $1 million. The income on the property, again, really high level numbers here. We're going to use the full 52 weeks of rental income at $700 a week, and that comes out at $36,400. So best case scenario, you buy this $1 million property, $700 a week, it's going to produce you $36,400 of total income, less the expense of the interest repayment, and you're going to have $11,400 of surplus income. Now that's the gross yield. Now that doesn't take into account the maintenance, the rates, the insurance, the property management fees, any other costs associated with the property. But you can see that when you do a quick and dirty calculation on a property, people want to know what the rental income is, and generally, where, and if it's in a good area, whether you should use 52 weeks or 49 weeks, or they want to know what the interest rate is and for how long you probably can fix it on interest only. 5 years is generally pretty doable for most property investors. We could, if we want, we could change all these numbers using this pretty simple calculator, and you can see that if we take the surplus, we drop out all the other costs, might not be that much left over. The reason people are happy to do property investments like this for this type of gross yield is the capital gains. Now, a $1 million property, say in Auckland, in a nice suburb, the capital gains of 5% a year, that's $50,000 increase in value. Now, I've been keeping an eye on a lot of properties lately, and I'll check them one week, and then I'll check them in the next week, and there might be a $50,000 or even $100,000 gain in that week because of recent sales. That's just the market that we're in at the moment. So instead of using, say, 80% gearing, where some people might do a 20% deposit and 80% finance, or even a 70% finance, and they'll work out the gross yield using those numbers, most investors are going to be using 100% purchase price as the finance, and they're going to be doing high level numbers on that. Once you take away these other costs, you start getting closer to the net yields. And if you want to get even more complicated, definitely not numbers for dummies, is cash on cash return, and you'll be able to see whether it's worth doing buy and hold for a longer period of time, or if you're really super focused on your return on cash, you might be looking at recycling your portfolio if that property doesn't produce the yield you want after that sort of 5th, 6th, 7th year. Different kinds of investments will produce different kinds of yields, and that's why it's important to assess what you want out of your portfolio. So that's gross yield for dummies. When you're talking about cash flow, you want to make sure that when you're asking any investor about how they work out cash flow, that you're using the same formula. So what I'm going to do is wipe out these numbers, I'm going to put in some random numbers, and then we'll do those numbers together. So we've got a purchase price of $763,000. We've got an interest rate of 2.79%, something more realistic. Maybe you want to do your numbers on like a 3-year rate or something. So we take those numbers, 763 times 0.0729, and that's our annual cost, $21,288. That's what we're going to pay as an interest only expense to the bank. And then we're going to take the weekly rental amount, $523 a week, times 52, and what we get is $27,196. So best case scenario, we're going to make $27,196, and it's going to cost us $21,288 a year. So we take those numbers minus cost, and you can see that we have a surplus of $5,908, and that is our gross yield that we have to take these other expenses, maintenance rates, insurance, property management out. But you can see very high level, very important to know what the rental income is, interest rate, and the total amount, and then you can do numbers. You'll be able to do it in your head pretty quickly once you get the hang of it.